Hey folks, Ashley Garner here. So coming to you today, we're going to talk about very high level stuff on what happened in the big beautiful bill that pertains specifically to people who invest in real estate. And so if you know me, even if you don't, you probably can figure out I'm not a CPA or an attorney or any of those things that you need a whole lot of education for, right? Now I do have an accounting degree, so for whatever that's worth, but I'm definitely not CPA. So you got to consult your own people on this kind of stuff to make sure specifically how it affects you and your situation. But I will tell you the general parts of it, and then you can do some research on your own. And hey, you might even ask some, whatever your favorite AI source is, and read up on it. But the gist of it is this: the government incentivizes people to do what the government wants them to do. So in our case, the government wants somebody besides themselves to provide housing for people. Okay. So in our case, we do multifamily investing, and the government says, hey, the residents of the United States need places to live. We're not in the business of providing places for people to live. So we need you to do it. And in order to make it attractive for you to do, we're going to give you these incentives. So the big beautiful bill, that it didn't really create anything new. It kind of preserved and reinstated some of the things that used to be in the past. The number one thing is bonus depreciation. So again, the gist of this high level is that you can depreciate the improvements to real estate. So, the structure itself, the building materials, the asphalt on the parking lot, the sidewalks, the toilets, the faucets, the light switches, all of those things have a life. In other words, just like in your own house, at some point they're going to wear out, right? And so it's not worth as much today as it was when you put it in brand new, right? That's depreciation. So the value goes down. So when we buy something, one of the first things that we do is enlist an engineering firm to go out and do a cost segregation study. And in this study, they literally count every light switch and every toilet and every faucet, et cetera, et cetera. And they say each of these things has a expected life as prescribed by the IRS, and then that's its lifespan. So you can take the value of it and you can depreciate it that much each year on would be called straight line depreciation. What bonus depreciation allows you to do is accelerate that and take more of that depreciation sooner. So what the big beautiful bill did is it said you can take 100% bonus depreciation. So that means we do our cost segregation study and we get our amount of depreciation, and you subtract from it the profit you make, and that's your net depreciation. And you can take all of that in the first year of ownership. Well, that's a pretty big deal. So if you're an investor in these things, then what tends to happen is, you take all that loss in the first year, even if you've made cash, even if you've received a distribution or made money, made cash, you still have that big loss. So it comes through on your K1 or whatever tax document you get as a negative, and then you can use it to offset other of the same type of income, or maybe just the income from that particular investment if that's all you've got. So there's all kinds of stuff to talk about with this, and I don't know if we can get into all of it, but let's talk about this example right here on my high-tech whiteboard, okay? This is not the smart board like my kids have in school. They've got these fancy ones that do all kind of cool stuff. Mine's just like magic markers. So, all right, bonus depreciation, big beautiful bill says makes permanent. I guess that's permanent until someone else gets in office and they change it. But for now, it's permanent. 100% depreciation, bonus depreciation in year one, okay? Reduces taxable income. And here's our example. These are round numbers that I have lowered to be very conservative, but it's based on an actual current investment that we have going on, which, by the way, we're still raising money for if any of you want to learn more about it. So the performance in real life will be better than this, but I never like to overpromise things. So the gist of it is this: we bought it for $21,250,000. Okay, we get our cost segregation study, and hasn't been completed yet, but the estimate is that we will get roughly $4 million worth of depreciation that we can take in year one. $4 million. I think it's going to be higher than that, but for this example, we'll use 4 million. The next thing we got to do is we got to subtract our net operating income. So this is the amount of profit that we expect the property to make in the first year. Okay, so we're going to use 1.5 million. Again, we think it's going to be more than that, but for this example and to keep round numbers, we're going to use 1.5 million. So we subtract these two, that leaves us with 2.5 million of loss from depreciation that we can then use on our taxes for the 2025 tax year. Now, let's say that you're a passive investor, okay, and you've invested money into this deal. So this is called a syndication structure, by the way. And, general partners are what I am. Limited partners are people who invest money and then they receive information reports and distributions and K1s. And then, after it's all said and done, the idea is that limited partners make a bunch of money and they haven't had to lift a hammer and collect the rent and do all those things. That's the general idea, right? So say you own 5% of this particular asset that we're talking about. Well, that means that you would get a K1, which is the tax document that you have to use to prepare your own taxes. And instead of saying that you made $20,000 in whatever your share of the distribution was, in this case, it's going to say 2025 that you have a negative $125,000. So it's a passive loss to you as a limited partner. Now, what does that mean? Well, that means that you are reducing your tax liability or your exposure to pay taxes by that much. So let's say, for instance, that you already own a bunch of passive, you already have a share in a lot of real estate investments as a passive investor, okay? Let's pretend you're a banker or a doctor or a business owner or whatever. That's not real estate, right? And so you own a bunch of these investments, and let's say that you made, just by coincidence, you made $125,000 in 2025 from all those other passive investments. And then you invest in this deal, and because of bonus depreciation, you now have a $125,000 taxable loss on your K1. So you made 125, you lost 125, lost, and you put those together, and that's a net zero. So now you have zero taxable income on the passive investments. That's a pretty big deal, right? You made a bunch of money, you use this loss from depreciation, and now you don't have to pay any taxes on that portion of your investment portfolio. That's a huge deal, okay? Let's say this is the only passive investment that you're invested in, okay? And this is your first one. You thought you'd give it a shot, and so you went ahead and you invested 5% worth into this deal. And now we give you a K1 at the end of 2025 that has a negative $125,000 on it. Well, the distributions that you hope to receive in 2025 from this particular property won't be anywhere close to 125,000. Maybe they're, in the first year of purchase, we normally anticipate our payouts beginning at the end of the third quarter of ownership. So the timing of it in the year, in the 2025 tax year, you might not receive any distributions from this property just because of the timing of when it was purchased and when we start paying the distributions. So say you receive zero cash, but you get this K1 for a negative 125,000. Well, in that case, you can't use any of it because you don't own any other passive investments. This is your only one. You didn't receive any distributions or profit from this one. So you don't have any taxable income, but you got this big old taxable loss. Well, now you're going to carry that forward. You don't lose it. You carry it forward to future years until you have some passive income you can use it on. So next year, 2026 comes, and maybe you make, maybe you make 20,000 bucks from us. We send you 4 distributions of $5,000 per quarter, and now you have $20,000. So you subtract that from the 125, which you're not going to pay any taxes on, by the way, because you're carrying that loss forward. Subtract 20,000 from that. Now you have $105,000 still of passive loss that you can continue to carry forward. So it's theoretically possible in deals like this, in a 5-year hold period, for example, that you could receive cash payments every quarter for 5 years and not pay any tax on it. That's pretty good, right? I don't know what your job is, but normally on your job, if you're getting a paycheck, then you're paying taxes on it. Well, in this case, you theoretically could get a paycheck and not pay any taxes on it, right? So it's kind of a big deal. There is one other special situation that is really important. So for those of you out there who are real estate professionals in the eyes of the IRS, okay, like me, I have a broker's license. Real estate is all that I do. All of my work is in the real estate field, and all of my income is from real estate. So everything that I make from these deals and other parts of real estate is considered ordinary income, or it's all in one bucket. And so the IRS says I can use my losses from an investment like this towards all of the other money that I make. So I might make money from commission on real estate or other investments that I have that are cash flowing. And now I get my $125,000 loss on my K1, and I can offset all of my other income. So, I don't know how much money that I'll make this year, but it's theoretically possible that I could wipe out all or most of it, the income, with a loss from something like this, and then not have to pay any taxes, or at least reduce my taxable income. So for those of you who are real estate professionals, this is a really, really big deal, okay? You can greatly reduce your tax exposure. And in fact, we have several, as you might expect, me being in the real estate business, I know a lot of people who are in real estate. And we have a lot of investors who in these deals that we promote who are real estate professionals. And let me tell you, they are very, very happy when they get their K1 to prepare their taxes for the previous year. And they get to see how much it reduces or how much they've saved in taxes because they're invested in something like this. It's a big deal. Now, as you might expect, nothing is as simple as just that. And I know how I have a way of speaking that's very simple. And we'll call it layman's terms as opposed to simple. Maybe that sounds better, right? But the point is that there are things like recapture. So when you sell something, if you've taken all of the depreciation up front, but you only own the asset for, say, 5 years, right? Well, you then owe the government back some of the depreciation that you already took. And I think normally that's taxed at a 25% tax rate. So you say, well, I've got to pay it back. I don't want to pay recapture. But think about this. Let's say you're in the 37% tax bracket, right? You don't take this. You receive the income. It's taxed at 37% tax, right? Well, and you're paying that right now. So theoretically, you get 5 years out, the general partnership decides to sell the asset, and now you've got to pay recapture on the portion that you took that you don't own it. So there's a calculation, and it's kind of complicated. But end result is you got to pay 25% tax on that portion. You have saved the difference between the 25% and the 37%, if you want to think of it that way, saved. But the real benefit is that you've got the benefit of using that money for 5 years when if you didn't take that, you would have been paying taxes on it. So again, the idea is the government's trying to incentivize you to invest in more residential real estate so you can provide more housing, okay? And the dollar is worth more today than it might be in the future. You don't know what's going to happen in the future. You don't know what the tax rates will be. They might go up. You don't know what the dollar will be worth. It might be worth less. And plus, you can't invest something based on what you might have in the future. You can only invest what you have right now. So at the end of the year, if you have more money cash in your pocket because you saved it here, now you can invest in more things. Now you can grow value at a faster pace. That's what this is all about. So again, It can be complicated. It is complicated, and you need qualified professionals to help advise you on this. CPAs, tax professionals, attorneys. We would love to have you ask lots of questions. And if you don't have those professionals, I'm happy to refer you to some that I use. Maybe there's some in your particular area that you would like to use. If you've got any good ones that you would like to share with the world, leave a comment here. We'd love to have the interaction and to hear your opinion of this. Again, I'm a very layman's terms kind of speaker, but I will promise you this will make a large, large impact on your life and your pursuit of financial freedom. Okay? All right. We'll talk to you again soon. See you.